And now, Daljit Dhaliwal.
For companies with the resources and the nerve, the global economic downturn is a buyer's market, and two possible places to invest, according to our next guest, are India and China. For some insight into how both nations are weathering the financial crisis, we're joined by Dr. Anil Gupta of the University of Maryland's Smith School for Business. He recently co-authored Getting China and India Right. Dr. Gupta, welcome to the program.
Delighted to be here.
So what makes India and China among the few bright spots for investment given this dire economy?
I think I would say, pick at least two big reasons. Number one, that of the 12 largest economies in the world, China and India, along with Brazil, but China and India way ahead of Brazil, are still the two fastest growing economies. A big slowdown from what the picture was in 2007 or before. So China last quarter, 2008, grew at 6.8%. India grew at about 6.7% estimated. Big slowdown from the earlier period, but still quite robust by the standards of the developed economy. So relatively speaking, they are still growth economies, decent growth economies. That's number one. So you want to invest in growth markets rather than in mature or declining markets. Number two is that in terms of asset valuations, that while asset valuations have come down quite sharply all around the world, including in the United States, the asset prices have come down even sharper in China and India. So that if we say these are still the two best growth opportunities with the lowest asset prices, that makes them attractive targets to be doing some hunting.
But I guess the big problem is the lack of confidence. I mean, there has been a flight of capital from India. I mean, something like foreign investors sold of, $10 billion of their investments, which were in Indian companies. So how do you get these potential investors when the instinct is surely to hunker down and to do it close to home, not overseas?
Exactly. And I think the instinct is clearly to hunker down. But this is, where I would say that, think like Warren Buffett. Essentially, you have to be a contrarian. A contrarian doesn't mean that you have to be ideologically contrarian and do stupid things. But essentially, investment should be made with the long term in mind. But, looking at from a pricing, from a timing point of view, what is the short term situation? And the long term story for China and India still remains more attractive than, virtually any of the other top 10 to 12 economies. And the asset prices today are about as low as one can get. So I think that one needs to think like Warren Buffett. He had stakes in PetroChina, for example, which he sold at the peak when everybody was jumping into China. And so, in fact, he sold when the market was at the peak, and this is the time to buy when the market is at the bottom.
Right. So if you are a company and you've got capital to invest, what is the right way to leverage yourself, and what sectors should you be looking at in India and China? Which areas are doing well and which ones are performing badly?
I think and again, of course, we have to take into account the regulatory barriers that may exist. So, for instance, China doesn't permit foreign entry in certain industries, and India doesn't permit foreign entry in certain industries. So, those are barriers but leaving aside the restricted areas, I think in India, particularly, I would say anything connected to infrastructure would be a very, very good place to be thinking of. And anything connected to technology also would be a very good place. Because, looking at infrastructure and whether that is engineering firms that take on projects or equipment suppliers that supply, that because the infrastructure story in India is about the only robust story right now when I talk to people on the ground. And India has started the infrastructure quote-unquote revolution that China started in 1996. So I think that story is going to play out. Everybody realizes that. Private sector, public sector, politicians at the center in the states. So that would be one. In China, I would say places to look at would be consumer goods in particular, because I think the export growth story of China is over. And when I say it is over, because already China accounts for about 10% of the world's exports. If China's exports were to continue growing, forget for the moment the last 4 months, 5 months, but if China's exports over the next 12 years were to continue growing at the rate at which they grew over the last 5-7 years, by 2025, China's exports would be 50% of the world's exports, assuming that the world exports continue to grow at the same rate. Simply not going to happen. So I think China's future is domestic consumption, and consumer goods would be a fantastic place.
And in your book, Getting China and India Right, I mean, you write that India is China minus 12 years. What was the cause of China's economy growing so much faster than India's, and what factors perhaps are helping India to catch up, especially in the middle of an economic meltdown?
Yes. No, I think India is not going, this is not a time for India to catch up with China in the current economic meltdown, even though India is doing quite well relative to other economies, but still it is slower growing, slightly slower growing than China, even in Q4 2008, and that will be the picture in 2009. But going back to your question about, what I like to say is I equals C minus 12 or C minus 13, is that India started liberalization, global integration in 1991. China started that in 1978. And it's that 13-year gap which is alive and well. In fact, if you look at it in many ways, that we take India's GDP 2007 and compound it at 8%, which is not unreasonable over the next 10 to 15 years, because India grew at 9+% over the last 5 years. And so if we take India GDP 2007, compound it at 8%, 2020, India's GDP will be what China's was in 2007, net of inflation. So I think that 13-year gap, 13-year gap is alive and well.
Dr. Anil Gupta, thank you very much for joining us.
Pleasure to be here. Thank you very much.